The way I tell people when I do real estate coaching is I say, you need to know where your tenants are going to go for pizza on a Friday night.
Yep.
You should know what that neighborhood that you're looking at, what it's like, what's nearby, what's the crime like, all those different aspects when you're thinking about buying a property.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, welcome back to this episode of the Ironclad Underwriting Podcast. And again, I am with my friend and business partner, Frank Patalano. How are you doing, Frank?
Hello, sir. Good. Another great day.
Yep. And I wanted to talk about one thing that a lot of newbies or people who are just starting out come to me and I say, hey, what market are you investing in? Or which one do you want to invest in? And then they rattle off like, I want to invest in North Carolina, South Carolina, Texas, Ohio, and Utah or something like that. Totally like all over the globe or all over this map. And I like cringe every time I hear that. And I know you and actually invest in pretty much all of those states that I just mentioned. But when you're first starting out, I think you should concentrate on a single market. Now, granted, you and I have been investing in what 20 plus years a piece or so.
Yeah,
So
definitely.
we aren't just starting out. We have invested in a single market and then expanded. But what is your take on that?
I was going to say, do we want to promote the concept that you should be focusing on one market or that we shouldn't be focusing on one market? So, I mean, this is the problem that you hear all the time. I mean, and it's not just real estate, you hear about it with stocks too. There are people that say, oh, diversify, diversify, diversify. There's other people that say focus, focus, focus. So I've seen it both ways. Now, when I started out, I mostly started out in one market. All of my investments, my first 40, 50, 60 doors or so were all in one market. Okay. And do I think that's a good idea? Absolutely. The way I tell people when I do real estate coaching is I say, you need to know where your tenants are going to go for pizza on a Friday night.
Yep.
You should know what that neighborhood that you're looking at, what it's like, what's nearby, what's the crime like, all those different aspects when you're thinking about buying a property. So it's hard to do that if you're in 10, 12 markets. I mean, now it's a little different for me because of partnerships. But when you're first starting out, what I tell people is if you can't focus on one, fine, focus on two. Focus on where you live now and focus on where you want to move to or where you want to vacation or something like that.
Yeah. And you brought it up, partnerships. You want to have somebody near that market that you're investing in.
Oh,
You're not going
absolutely.
to invest in a market where the closest person is a 6 hour flight away or a 3 hour flight away. I know some people say, well, I can get on a plane and be there in an hour. It's like, okay, well, what happens if there's a cloud in the sky and planes aren't flying that day? Then not going to be there for a day or so. But from an underwriting point of view, concentrating on a single market would be ideal because when you're analyzing all the crime statistics, you're analyzing all the comps and everything. That is a lot of data to digest just for a single market. And if you're trying to do that in multiple markets, you're going to be overwhelmed and I know you're definitely going to miss some things, but you can't, one person can't do that. A small team can't do that. So once you like get grounded in a market, then I would suggest you expand. But I tell my students, you want to know everything about that market. Like you said, you want to know where they're going to get pizza on Friday night, but I want you to know what the complexes are that you're in direct competition with yours, who manages those, who the owners are. Um, have a good relationship with your own management so that you can have them. And our market that we're invested in North Texas, our manager has a good relationship with other managers, and they can just call up and get comps on a phone call. Can you do that in every market? Maybe not, but you need to be able to figure out how you can get comps easily, whether it's through secret shopping or just going to apartments.com. But I mean, all of that takes time and resources. And if you're doing that for 20 different markets, you're spend all your time doing that. So
So to follow up on what you're saying, I know there's like Neil Bawa. So obviously we own a virtual assistant company. Neil Bawa has an army of VAs that are doing this kind of data crunching all the time, and he struggles to do it in many markets at the same time. He's able to
yeah.
pull it off, but I mean he has 30 or 40 employees doing it. So obviously
but
whole
but
different ball game versus you and I starting out or maybe having one or two employees.
but also Neil Bawa isn't just starting out.
Oh yeah, no, I
Most
agree.
most people starting out don't have an army of 30 VAs.
Yeah, yeah. No, I agree. That's what I'm saying. And no,
So
I'm supporting what you're saying. I remember you and I took a flight, I don't know, a month and a half ago now. Or you took a drive. I took a flight. We hit Oklahoma City hard. We had a possible deal there, and obviously it was about 2.5 hours from you, and it's halfway across the country from me. And we really didn't have a boots on the ground person in the market, but we did have someone that was traveling there twice a month, stuff like that. And we drove the competition. We looked hard at what the other complexes looked like. And even though we kept negotiating a better and better and better deal, the deal ended up falling apart because it didn't work. But the main reason why it fell apart was when we saw the competition and what the competition was offering, we knew that it would be tough to raise rents to a point to still make the numbers work.
yeah,
And if you're not in the market, it's hard to see that. I mean, we literally drove to the five closest apartment complexes. We saw what they were showing for available units. We looked at the price points, and it's like, yeah, if we're going to spend $1 million in rehab on this, we have a problem.
yeah. And like you said, this was in Oklahoma City, which I would consider a primary market. It might not be as big as like DFW or Houston, but we were looking in basically a specific zip code of that primary market. So when you're investing in, it's like, well, I'm going to invest in Dallas. You need to like even narrow it down further because DFW Dallas is a whole lot different than DFW Plano or South Lake, and they're all within the same
Yeah,
MSA, but they're all different zip codes, and so you like need to narrow it down to like one, but maybe three zip codes depending on the size of them and everything. So
absolutely. The DFW market is bigger than some states.
yeah,
So, at least one state. And then, yeah, no, you're definitely right. I mean, when we were sitting in Oklahoma City, after you guys went home, we had lunch with a pretty good real estate investor in that market, and we asked them what they thought about that neighborhood. And she's like, kind of a C, low C. And she says, I wouldn't invest there. And she gave us like five other well, not zip codes, five other neighborhoods that she'd be looking at first.
yeah,
And that's just like you said, that's just in one metro. So when we say a market, I mean we're talking about the whole metropolitan area of that city, so
yeah.
versus
I
submarket and stuff like that.
Yeah, and actually, my students do come to me and they're like, "Well, are we going to do market analysis?" And I never really wanted to jump into market analysis. I always assumed, hey, my students should already have their markets and they're already looking at deals, and I'll just help them figure out the deals. But a lot of my students actually wanted market analysis, and there's a lot of resources out there that are free and everything, like city-data.com. Google is your
Yep.
friend. And then we can put a handful of others in the show notes below. But it's like then sometimes you can get into specific zip codes for each of those MSAs, or the metropolitan statistical area. Um, but yeah, there's a lot of research to be done. You need to know, like you said, it was a C class neighborhood. Well, what does that mean? Well, I want to be in a C class neighborhood because I want to support working class people. It's like, well, okay, that's fine.
We've
Then
definitely
that,
done that before.
yeah,
We're doing that now on some of our properties.
yeah, and if that's what you want to do, you have to know that going in. You can't buy a property, say, okay, it's a C class, I want to bring it up to a B. You're going to bring a B class property up in a C class neighborhood. Really doesn't necessarily work out that well. It's easier to flip it, bring a C class property up to a B in a B class neighborhood. Um, but you have to know the area where that property is, like the neighborhood. Um, you have to know if that fits into your business plan to be able to do stuff. Is like, okay, well, we're buying a C class property, we're going to bring it up to a B, and we're going to raise rents $450 on average per unit. Yeah, that may or may not work. That depends on a lot of research on that market.
So one of the things I say with that is I'd rather own the worst house in a nice neighborhood versus the nicest house in the worst neighborhood.
Yep, I
Yeah.
agree. And there's some properties in we're in our market where we invest in North Texas where they had a C class property. They brought it up to, they tried to get it up to a B class, but the neighborhood is C class. And they pretty much had to like make the whole a complex, a gated community just to keep the riffraff out. Because inside of C class prop or neighborhoods, you're going to have people dumping all their stuff in your dumpsters just because it's convenient, or they have too much stuff to fit into their own dumpsters, or maybe they just have like curbside trash pickup and they're only allowed one trash can out in the street every time, and they have a bunch and they're throwing away mattresses. Your dumpsters are going to get filled up pretty quickly. Um, I know pools. If you have a pool, you might have neighborhood kids coming in and playing in your pool. So again, you have to be basically a gated community. Basketball courts or other activities, you're going to have neighborhood kids coming in. So I mean, there's, it's not just I'm going to bring this up to a different class of property. It's what is the neighborhood and is it worth the headache?
Yeah, no, I agree, especially starting out. I mean, if you're experienced and you can see where the path of progress is, if you have knowledge that the city is investing in a certain neighborhood and the neighborhood has a lot of rehabbing going on and you think that the neighborhood is going to go up a level in quality, then that's different. But it's tough to be you being the lone wolf going out there, putting in the extra risk and the extra time, and the community or at least the municipality is not helping you improve the neighborhood.
Yeah. And then that goes into, if you are investing in a market, maybe you should try to get into some of the town hall meetings or some of the city boards or something, because I mean that directly affects your property, and so you can sort of lead the path of progress if you get into that route, but you can't do that if you're in multiple markets. That's even getting into the weeds of a single market that most people don't get into.
I remember when we bought a property and we hit the newspaper, and my partner was very excited to talk about how we were turning the property around, and it wasn't always the best property. Well, we did move it up a little bit, but it's it's not going to be a trophy property or the perfect property anyway. And when we had different managers go through over time, we're on a third property management company, and yeah, we've had some issues with the previous ones that hurt the growth
Yeah.
and the improvement of the property.
Yeah. So I guess moral of the story is when you're starting out, stick with one market. And I recommend, even if your market that you currently live in, as just like that you reside in, even if it's not ideal or perfect, I would start out in that. Um, One, because you know everything about it. You know where to get the pizza on Friday nights. You can drive by the property more often than not. Um, Going off of some statistics, population statistics, if I didn't live where I live, I wouldn't invest how I did here. just because the growth has been stagnant for the last 60 plus years. But I know what the good neighborhoods are. I know what's not good neighborhoods, what we can do to improve and stuff like that. So I recommend starting in your backyard now. Granted, if you live somewhere like LA or on one of the West Coast states or East Coast states where you have rent control and it's not very landlord friendly states, I might move away from those. But generally, if you're walking around your neighborhood and you're looking at buildings that are people are using, you can think, oh, okay, somebody is making money off of this. How do they do that? And then you can figure it out from there, or you can partner with someone in a more landlord friendly state like Texas. So
I recommend, especially starting out, investing wherever the strongest team you can make is. Usually, you're pretty big component starting out in your own team.
yeah,
So if you're the strongest person, you're going to invest there. You know, like you were saying, you might not have done the same style investing when you first started out in your current market. I would argue that at least you understand what the deals are. You understand where the opportunities are. You have a much better idea. I mean, even even locally to me, it's funny because we have a lot of colleges and they might have somebody that lists a triplex for sale, and it's like, oh, this is a great deal. And I look at the street, it's like, you guys are on the wrong side of the college. You know, if you want to sell at that price, by the way, somebody will buy it. It'll probably be an out-of-state investor that doesn't know they're on the wrong side of the college in the wrong neighborhood. They paid the price that's in the right neighborhood, but in the wrong neighborhood. You know what I mean? Because you didn't know enough about, there are certain communities where streets make a difference. You know,
yeah,
you can be one or two streets in a certain way. And unless, like I said, unless that area improves over the next 10 years, there's times that it doesn't change and doesn't improve.
yeah. It's like kind of like being on the wrong side of the railroad
Tracks.
tracks.
Yeah, yeah. I mean, you have a property, we don't even need to mention names, that we've driven by. It's that one shuttle of properties on both sides. Um, begins with an L. And if it was in a different neighborhood, maybe and if it was kept in better condition, it'd be worth different values. I mean, you can have two houses. The beauty of real estate, you can have two houses in the same street, and they can be vastly different prices.
Yeah, and that actually gets into other nuances of commercial versus like residential investing. Where residential, you're gonna be basically limited by your neighborhood. With commercial, you're limited by however much you can get your NOI up for like appreciation. But to get your NOI up, you have to match market rates and everything else. Otherwise, your NOI is going to drop significantly. Ask me how I know. And when that happens, your valuation tanks. And so there's a lot of nuances that are market driven in both residential and commercial properties.
Yeah,
So
smaller residential is comps based. Larger residential and commercial is more income based.
yeah. Um, anything else you want to add on?
I mean, I would say that over time, once you're comfortable in one market, you can definitely move to some other markets. Um, I'm a fan of some diversification because we've had some markets that just haven't performed well.
Yeah,
The market, that local city has sometimes gone downhill a little bit. Or maybe not the whole city has, but just unluckily the neighborhood that we invested in has not done as well. So, you know, there is an idea that when you get to a certain point, you should diversify your assets. You don't want to have all your eggs in one basket. But starting out, I like the idea of being in one market.
yeah. And I didn't even mention this, but when you're concentrating on a market, and you have multiple assets in that market, you are your own comps. So you can sort of like force what everything is doing. It's like, all right, well, I got three complexes within half a mile of each other. Guess what I can do? I can bump rents $25 on all of them, and there's nothing really anybody can do because that's where those people need to live in that whole area. So I mean, you're your own comps. I'm not saying don't do anything unethical or anything. I mean, we are trying to provide adequate housing at a decent price for people, but so we don't want to gouge them. But it does help in knowing what you can rent for versus like kind of guessing what you can rent
You
for. And
can
then,
help push the market a little bit, but you can't expect to be crazy higher than the market because people just move to another neighborhood.
yeah. And unless you can provide amenities that would justify the
There you go.
increase, and sometimes you can. So, um, I was going to say something else. Oh, if you look at a lot of the big players, I think like Rise 48, they started in Phoenix and then they expanded into DFW like a couple years ago. Well, they've been in Phoenix for what, 5 years, getting billion in assets there, and then expanded. Ashcroft Capital, they started in, I forget if they started in Cincinnati and then moved to DFW, or started in DFW and then went to Cincinnati. But I mean, they have people living in both places, and so, or they're there a lot. So that's why. And I think they're actually expanding further. But again, they have almost 3 billion in assets under management. So they've been doing this a while. They know what they're doing, and then that gives them the ability to expand as well. So, but yeah, stick with one market, your backyard, if possible. Partner with somebody if it's not possible. And your general rule of thumb for boots on the ground for a partner in a market is what, a 90-mile drive or
90
so,
minute.
90-minute drive furthest
Yep.
away. And DF and in Texas, sometimes we might push that a little bit further just because everything's further in Texas. But
My first deal on the West Coast, it was 2.5 hours, and the people did not end up being as boots on the ground as we had hoped. So
yeah,
that's why I'm keeping. Usually it's 90 minutes.
so that's what I use as a general rule of thumb as well. So
Awesome.
anything else? I think that's good.
No. Yep.
Nope. All right. And if you have any questions or want to learn more about how to analyze markets or how to pick markets, you can hit me up. Again, Jason Williams with Ironclad Underwriting. You can go to ironcladunderwriting.com. I'm on LinkedIn, YouTube, Instagram, Facebook, pretty much all the platforms, whatever one you're listening to this on. Um, Contacts in the show notes. And yeah, love to hop on a call with you and discuss your underwriting and market analysis further. Thanks. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.